Welcome to the TreppWire Podcast, the show where commercial real estate meets data and insights. This is our week in review for the week ending May 29th, 2026. I'm Haley Keene with Trepp, a data modeling and analytics firm for the CMBS, commercial real estate, and CLO markets. I'm with Lonnie Hendry, Chief Product Officer, and Stephen Bushbaum, Head of Applied Research and Analytics. This week, the macro backdrop is giving us a little bit of everything. Rates are still elevated, inflation concerns are still hanging around, consumers are showing some fatigue, and yet markets have continued to push higher. The latest Fed minutes kept the focus squarely on inflation, energy prices, and the uncertainty tied to the Middle East conflict. Consumer confidence also slipped slightly in May, with households still very focused on prices, oil, gas, and the direction of interest rates. And in housing, mortgage rates moved back up to their highest level since last summer, which keeps affordability very much front and center. At the same time, equity markets have been surprisingly resilient, with the major indices setting fresh highs this week. So we're still in that familiar 2026 tension. The data is not screaming recession, but capital costs continue to matter a lot for real estate. That makes this a great week to talk about pricing, valuations, and investor appetite across commercial real estate. We'll spend some time on the proposed Equity Residential and AvalonBay merger, including how you can use the transaction value and financials to back into an implied cap rate for the combined apartment portfolio, and what that may signal about the disconnect between public and private market pricing today. We'll also get into several major property-level stories across the market, from Chicago multifamily activity and San Francisco office recapitalizations to continued corporate migration out of downtown Dallas and a few office-to-resi conversion stories. So, Stephen, start us off with the macro backdrop. Rates, inflation, housing affordability, and then a major apartment REIT merger. How should we be thinking about the through line this week?
Well, I think the through line this week is capital costs are still the story. The broader market has been pretty constructive. Real estate is still dealing with the same core issue. Where do real estate settle, and how does that flow through to valuations, transaction activity, and investor appetite? Now, I got to say, this week, the core PCE and headline PCE numbers just dropped on Thursday morning. It wasn't as bad as it could have been. I mean, I guess we can take a bright spot there. The core PCE index increased 0.2% on a month-over-month basis versus 0.3% that was expected and 0.3% that was last month. And headline PCE increased 0.4 versus the 0.5 that was expected and the 0.7 increase that we saw last month. Now, keep in mind, this is the April inflation. So, I mean, at this point, it's pretty stale. You know, we still have all of the May data that eventually we'll be digesting here relatively soon with the CPI, and then later in the month, the PCE once again. But I guess we can take that away. Inflation wasn't nearly as bad as it could have been. I don't know. Lonnie, how do you feel about the inflation print this week?
I mean, listen, I think in this stage of the market, you're looking for any silver lining you can get. And to your point, not as bad as it could have been can actually be spun into a fairly optimistic position. And I think that's how people will generally react.
Yeah, I mean, the mortgage rate move is a good reminder of that, though. Like, okay, it's elevated, but at the same time, transactions are still getting done, right? We're still, the math still pencils on some transactions. So it's not like we're going to see a wholesale dead stop. I think I've seen, a couple like kind of early statistics on April transaction volume. And I mean, it was down fairly notably. So we have seen, I think, a dramatic deceleration. It's just a matter of what the final like quarter end number is going to look like for second quarter.
Well, when we had our Trepp Connect conference, Victor Kalanog had a slide that looked at prevailing interest rates over specific time series. So like 10 years back, 20 years back, 30 years back. So, the takeaway there was just if you go farther back in history, today's rate environment is actually completely normal. Even as we're calling these elevated rates on a relative basis, they're in line with what we've seen historically. Now, over the last 10 years, obviously, they're on the higher end of the range just because we had that 5 or 6 year period of zero interest rate policy. But outside of that, this is where it's at. And I think the markets have just reset. And to your earlier point on inflation, at this point, we're looking for any signals that just where rates are is where rates are going to be, even though, we're not really going to talk about the Fed today, but it feels like people are starting to price in potential rate hikes at some point in 2026. So this is something that, to your comment earlier, I mean, we've seen really durable transaction pace and scale through the first quarter, despite some of the bumpiness here. I'm hopeful that remains, but it does feel like we're starting to see a little bit of pullback in some markets and for some property types.
Yeah, I mean, some of the just fever pitch in the transaction mantra was starting to feel a little bit overdone. So maybe a bit of a pullback wouldn't be so bad because, I mean, shoot, some of the REITs have basically been on the sidelines, especially the apartment REITs. We'll talk about that later, saying like, yeah, at these cap rates, it just doesn't make sense. In fact, we'll sell into this market. We'd be more than happy to unload some of our portfolio. If you're going to be buying it like a mid to high fours cap rate, like by all means, have it.
Well, that's the part that, I mean, you and I have spoken about this on some of our Market Pulse webinars and other events, but the stickiness of multifamily cap rates throughout this entire rate hike cycle and then everything that's followed has been pretty remarkable to me. I mean, you're not seeing the expansion of multi-cap rates anywhere near what I would have estimated them to be, heading into the Fed, going crazy on rates. It's, to your point, it's really remarkable that for a lot of these multifamily projects, you're still seeing that mid-4, very low 5 cap rate. And it doesn't make a whole lot of sense as a buyer, especially when maybe we're getting closer to it making some sense, because I do think the pendulum is swinging in favor of property owners relative to rent growth. And you're starting to see some easing on the expense side. It feels like insurance has really pulled back significantly from the all-time highs that we saw over the last 18 or 24 months. But to your point, it's incredible just to see how sticky these cap rates have been, and for market participants to still be willing to buy in, at those low cap rates.
Yeah, and that's why I think it'll be fun to walk through the math for the AvalonBay Equity Residential merger to see, okay, like we know these REITs are probably trading at a discount to net asset value. So maybe the implied cap rate from this transaction is going to be on the high end, but at the same time, if they're going to be building synergies with this transaction, perhaps like future capitalized yield is going to be maybe a little bit lower.
Yeah, I'm looking forward to doing a deep dive on that.
Now, speaking of multifamily, there was the headline out this week from BizNow about the Chicago multifamily sales market up 117%, absolutely on fire, which was, good to see out of the Windy City. Volume was up 42.8% year over year, which it was just over $4 billion in Q1. And this data was coming from Avison Young. Multifamily was the clear driver for overall activity. Investors spent about $1.9 billion on Chicagoland apartment properties in Q1, which is up almost 117% in Q1 compared to Q1 2025. Making Chicago the second largest U.S. multifamily investment market behind New York. And the recovery it's more than just deals, it's bigger than deals. The multifamily transaction count rose 31.8% year over year to 58 deals. And the article here is pointing to larger apartment complexes trading at higher valuations, including just over an 1,100 unit property near O'Hare that sold for $167 million. And fundamentals are doing a lot of that heavy lifting as well. Vacancy is just 5.1%, among the tightest in the country, and only 1.6% of current inventory is under construction, which gives investors a supply-demand story that's hard to find in a number of other markets. Now, there's still some headline risk here, especially around taxes, but they're more willing to underwrite around it. So this article notes that the rent growth has helped deal economics enough that buyers are increasingly betting on revenue growth that can offset uncertainty in the property tax environment. Now, beyond apartments, industrial sales topped $1 billion in the first quarter, up almost 43% year over year. Office was up 11.2% to about $466 million. And retail, surprisingly, was the weak spot, with volume down almost 19% to roughly $513 million.
Yeah, I don't want to pour cold water on this story because it's been a while since we've had a positive headline coming out of Chicago. So I'm supportive of Chicago. I love the city, and I'm long and very bullish on Chicago in the long term. But these year over year comparison figures are a little bit Yeah. Last year was terrible for Chicago. I mean, so it's like,
So maybe it's a base effect.
Yeah, what does the volume look like compared to the last 5 years or the last 10 years on a total dollar volume perspective? Because 4 billion for Chicago's multifamily market, yeah, it's a great number compared to last year in first quarter. But I think compared to what we were used to seeing out of Chicago, multis probably in line or maybe on the lower end of the spectrum. And then the industrial, like it's great to see industrial over a billion. That's a solid marketplace. But for Chicago, I mean, historically, at least over the last 10 years, I mean, their industrial activity has been on fire. So, it's great to see some positive momentum. I do like to hear the really tight vacancy numbers coming out of the multifamily side. And I think that supply and demand, imbalance in favor of owners there, I think is a positive sign for some continued growth. And maybe this is a catalyst that kind of gets Chicago back up and on the map here in terms of office and some of these other sectors. It's a little disheartening on the retail side because they've been known, historically for having such great street level retail. But listen, I'll take the silver lining here. It's great to see Chicago in the headlines with a positive story. But I do think looking at this more holistically would give us a perspective on where these numbers actually fit from a typical Chicago transaction market perspective.
Speaking of surprises, I saw some news about a fund liquidation, 24-year-old real estate fund. This one kind of surprised me, given all of the fundraising that's going on out there, especially how real estate has been front and center for a lot of the pivot away from private credit. And this was JPMorgan Asset Management is planning to liquidate its JPMorgan U.S. Real Estate Income and Growth Fund, which has been in existence for 24 years, has more than $1 billion in assets as of late 2025. And this fund launched in 2002. It grown into a flagship private real estate vehicle, but JPMorgan said they're winding it down, which is in the best interest of its investors, and that the process will be handled deliberately to maximize value. Now, probably no surprise to many, like the portfolio had been under pressure in recent years, like the rest of the sector. The North Dakota Legacy Fund's $170 million stake was down 1.7% in 2025, following a 3.7% decline the year prior, and had fallen 9.7% cumulatively over 3 years. And no surprise here, office exposure was probably a big part of that drag. The fund reportedly had 16% exposure to office, with the remainder split between industrial and multifamily assets. So this liquidation could actually take up to 3 years, according to documents from Mikita Investments, meaning it's less of a fire sale. It's obviously going to be a controlled wind down. As JPMorgan said, they're really going to be handling this deliberately to maximize value.
I want to jump in here, Stephen. This started in 2002, probably coming off of the dot-com bust. And so raising capital in that environment to take some opportunistic bets in the core plus type of marketplace. This has honestly had a great run. I mean, 24 years as a fund is, I think, pretty impressive. It's sad to see this kind of coming to an end, but I don't think this will be the last. I mean, the same composition and same story, I'm sure, can apply to a lot of these core plus type of funds that were, very productive for a couple of decades now, facing some headwinds just given to the composition and where the markets are currently sitting in terms of cost of capital.
Yeah, I don't think they're going to have any problem redeploying capital, as you get back in proceeds from the wind down. So yeah, this is probably a really good holistic opportunity on the whole to be able to redeploy back into some probably still very attractive opportunities. Now, we have the World Cup coming up this summer, and there's been some headlines out about, basically room demand not being quite as healthy as everyone has expected. Well, there's another angle to this story as well. I think you've probably heard about this one, Lonnie, about the unions getting their day in the spotlight. New York City hotel owners are going to pay dearly to dodge a World Cup strike. I mean, this is absolutely wild. So New York City hotel owners reached a new labor agreement to avoid a potentially disruptive strike ahead of the World Cup and America 250 celebrations. The agreement covers workers at roughly 250 hotels, and the wage increase is substantial. Housekeepers and other hotel workers will see wages rise roughly 52% over 8 years, eventually reaching $60 an hour by 2034. Unionized hotel workers could earn more than $100,000 annually under the deal. Now, for New York, that's probably fair, especially for what some of these folks are having to deal with. So for hotel owners, the trade-off was cost certainty versus labor disruption. The prior contract was set to expire June 30th, right before major tourism events, and industry leaders clearly viewed a strike during that period as too risky. I mean, obviously too risky to roll the dice on. The agreement adds more pressure to an already expensive operating environment. The Hotel Association of New York estimated the deal will increase owner costs by roughly 15%, while labor can already represent as much as 55% of a hotel's cost structure. Now, room rates are likely to face upward pressure as a result of this. Industry sources quoted in the article said owners have limited ways to offset higher labor costs, especially because union rules make it difficult to reduce staffing unless services are cut. So, I mean, this is just a clear case of margins are going to take a nasty, nasty hit.
That, is just really, it's a tough scenario. Is the cost of living and, downward pressure on service workers in New York very real? For sure. I mean, like it's challenging. Like they're going to have to live somewhere else and commute in. But can you reasonably justify paying, the housekeeping staff $120,000 a year to clean hotel rooms and think you're going to run a profitable business? I mean, like it just gets really tough. And I think you've seen this in some other sectors. I mean, we saw in California and a few other places where they raised minimum wage to $20 an hour. And now when you go into a McDonald's or their fast food restaurants, like you're ordering your food from a electronic kiosk, there are no more people because they couldn't afford to pay them that. And so now as a user or consumer, the experience is considerably less appealing because now you're performing the service. We've seen it at grocery stores where you're scanning your own groceries and bagging your own groceries because they didn't want to pay the cost. This is more unique because it's union and there's probably not an option just to go away from having the union staff. But if you're a hotel owner, this is going to be problematic for you because RevPAR and ADRs are starting to cool in certain markets, and as we've talked about, and we just put out a piece here, on the research side of some of the challenges facing the hotel sector broadly. I know this is New York centric in this particular example, but it won't be long before you see some of these other unionized states following suit. We can talk about the World Cup at some level too, Stephen. Like there's been a lot of controversy around the World Cup as it pertains to ticket sales and price gouging and misrepresentation. I mean, it's what we thought would be like a great get for the U.S. and a huge economic boon has not been, at least to this point, I think as positive as we had hoped for.
Yeah, I mean, the funny part about all this is I sit back and think like, well, unions are doing what they do best. There's a little bit of interference with free market because in New York specifically, it's not like you can just pivot to Airbnbs.
Yeah, I mean, listen, like we saw this with the union rep that was all over the TV with the port deals during the comeback from COVID and when all of the pressure was on for supply chain. Got to give these union guys credit. I mean, they are the master at maximizing leverage to their constituents' benefit, and so no pushback on that part. I just, from a mathematical perspective, to your earlier comment, I mean the margin pressure here is going to be very, very real.
So let's get into that larger segment we were talking about earlier regarding the AvalonBay Equity Residential merger. So I know, Stephen, that there's an interesting angle coming out of this merger announcement, and that's the idea of backing into an implied cap rate for the combined portfolio from the deal financials. I know you've been digging into this, and we talked about it a little bit last week, but why don't you walk us through how investors think about this exercise and what it might signal about pricing in today's market?
Sure. So a colleague of mine had mentioned this. They came across something on Twitter or X or LinkedIn where somebody had backed into an implied cap rate. And I thought, well, let me sharpen my pencil and see if I come up with the same answer or a slightly different one from what this post had mentioned. Essentially, what you can do here is take the combined portfolio, the enterprise value that was announced, and the combined financials, and do Well, I don't think you want to use it just straight as is. You want to do a little bit of tweaking, and you can come up with essentially an implied yield here. So the merger here is an all-stock merger of equals. There is no third-party buyer cutting a check at negotiated price. So this $69 billion enterprise value figure that's been quoted everywhere, it's the pro forma combined enterprise value. So this is important to note that this was the pro forma value on announcement day. You don't want to be looking at prices today. You want to be looking at the implied value of the firm at announcement day, because post-announcement, you get what's known as post-announcement drift in stock prices, and that noise is really not appropriate to be including in implied yield. So what we're going to do is we're going to look at, essentially what the cap rate for this public market is putting on the combined operating portfolio at the announcement day pricing. Now, note that this is a different question from what a private buyer would pay in an arm's length asset sale, but that doesn't mean this is a fruitless exercise. Arguably, it's actually really useful right now, given how thin comps could be in institutional multifamily space. And also, this is a public market signal, not a private market trade. So let's get into the mechanics. The framework for any REIT implied cap rate calculation, whether you're doing it on a merger like this or a buyback, is looking at where the name is trading on, say, like a random Tuesday. You take the forward 12-month NOI in the numerator and you divide it by enterprise value adjusted for non-NOI generating assets in the denominator. So enterprise value is the equity market cap plus debt at face value plus preferred plus minority interest minus unrestricted cash. The non-NOI adjustments in the denominator are what separates a quick and back of the envelope calculation from one that's actually useful here. So let's start with the numerator. For the first quarter 2026 prints, EQR posted total NOI of roughly $513 million across about 85,000 units. AvalonBay posted total NOI of $517 million across roughly 98,000 apartment homes. This includes about $8 million of commercial NOI from the non-apartment components of their mixed-use communities. So let's call it $509 million on a pure residential basis. For our purposes here, we'll use total NOI since the enterprise value captures both. Together, you have a first quarter NOI of about just over $1 billion, $1.03 billion. Well, if you annualize that, you're just multiplying by 4. That brings you to $4.12 billion. But you typically want to gross that up modestly for seasonal pickup and the peak summer leasing quarters. Remember, this is first quarter. This is still winter here, and you tend to have this pickup in spring and summer. And so the seasonal adjustment we'll do here is very much a back of the envelope. It's very much a gross, which way is the wind blowing adjustment. Now, the development pipeline is also ramping into service here. AvalonBay alone is projecting development NOI to grow from about $47 million in 26 to $120 million in 2027. That's roughly $73 million of incremental NOI from just one side of the deal coming online in the next 18 months. Layer all of that on, forward 12-month NOI lands at about 4.2 to 4.3 billion range. So let's call it 4.25 billion at the midpoint. So that's the numerator. The denominator, the headline is 52 billion pro forma equity market cap and 69 billion enterprise value, which implies the combined debt, preferred, and minority interest stack is around 17 billion. Cool, fine. So here's where the single biggest adjustment comes in. And this is the one that matters most for getting the analysis right. The combined company has a 4.4 billion, almost 11,000 unit construction pipeline. Construction in progress sits in the balance sheet at cost, and by definition, it generates no current NOI. If you leave that construction in progress or CIP balance in the denominator without adjusting the numerator for the NOI, it's going to generate at stabilization. You're artificially compressing the implied cap rate. So let me say this again. If you leave the construction in progress balance in the denominator without adjusting the numerator, you're going to artificially compress the implied cap rate here. So this is maybe where our implied cap rate might differ from some of the ones that you'll see online. Standard practice is to subtract construction in progress at book value from enterprise value before you run the math. Now, there are a few smaller adjustments you could make on a more polished analysis, like the pro rata for unconsolidated joint venture equity, AvalonBay's structured investment program mezzanine book at carrying value, land held for future development at cost, any non-real estate corporate assets. But For the combined entity, these are all relatively small and they're roughly offset. So now we'll run the numbers two-way. Method one, strip out construction in progress. So the adjusted enterprise value is $69 billion minus $4.4 billion of construction in progress, which gets you to roughly $64.6 billion. Divide 4.25 billion of forward NOI into that, 64.6 billion, and you land at an implied cap rate of 6.6%. Now, method two, the headline calc with no CIP adjustment. This is what financial press tends to quote. 4.25 billion divided by 69 billion gets you around 6.2%. And I think if you're looking online, some folks wouldn't have done the seasonal adjustment. So their numerator is going to be slightly smaller. So that could get you to maybe like a 6% cap range. So the broad range, 6 to 6.6% between maybe what some people are posting online and the upper end if you strip out construction in progress. Now, the honest answer is it's probably somewhere in between. If you not only adjust for CIP, but also forward stabilization, stabilized NOI over the next 12 months, meaning you give yourself credit for the full development ramp, you wind up at probably a range of 6.3 to 6.4%. So, right, the adjusted basis might be 6.3 to 6.6%. Now, I mentioned share buybacks, and here's the sanity check part of it, which is really valuable for listeners. AvalonBay disclosed on their first quarter call, they repurchased $200 million of stock in the first quarter at an applied cap rate in the low 6% range. That's not a coincidence. Buybacks are priced off of the same equity that the merger exchange ratio is anchored against and should produce a similar implied cap rate. So the math we just walked through ties out to management's own published number from 6 weeks before the deal announcement, which is a great cross-check. And now the punchline, which I think is the most analytically interesting, a 6.3 to 6.6% implied cap rate is meaningfully wider than where comparable coastal Class A multifamily has been trading at in the private market. We just talked about that earlier. Call it a mid to high fours, maybe low fives for trophy institutional product in the EQR and AVB footprint. That spread is the net asset value discount the public REIT shares were trading at. And it's arguably part of the strategic rationale for the merger itself. The stated synergy case is scale, balance sheet efficiency, and the 125 million of net overhead opportunities. That's all real. But underlying it is the reality that both stocks were being valued in the public market at a meaningful discount to where their assets would clear at a property level sale. So consolidation of that kind, public to private value gap is exactly where the type of activity you'd expect to see. So in other words, the sanity check math works.
I think this is a great framework that people can use, because it's just like anything else in the market, Stephen, where you see the headline transaction numbers getting thrown out there. Then obviously within the next couple of days, you start seeing people give some cap rate ranges of where they think this deal actually netted out. And there's really not a lot of explanation or understanding of how those are determined or what you need to do in order to calculate that. So I think for our listeners, obviously for some of them, this is probably a fairly basic calculation for them, given where they sit in the market. But for a lot, this is outside the scope of what they typically look at. I mean, we're CRE practitioners mostly focused on, property level type of cap rate calculations or imputation. And so I think this is a very good analysis. And it's, to me, it's interesting that the cap rates are +6, 6+, given what we just said about the stickiness of cap rates broadly. But I still think that's still an aggressive cap rate from a historical perspective. I mean, you're at a 6, just above 6. To me, this it feels where it should be, I guess, given current market dynamics. But nothing about that, sends any signals to me one way or the other that this is, a great buy or something that should cause a lot of concern.
Well, here's like the ultimate sanity check here, Lonnie, right? If we just do like cash on cash type leverage math in our head, all right, where's a 30-year amortizing mortgage going to get priced at interest rate wise?
Yeah, 6 to 7%.
Six handle. All right. So we have I wouldn't even call this neutral leverage, right? Because if it's an amortizing mortgage, the mortgage constant is going to be 7-8 handle, right? So
Yeah.
on a cash on cash basis, right, you actually have negative leverage. And I taught this in my real estate classes. It was probably, over a lot of folks' heads for an intro class for real estate finance. I think it started to click. But when you look at a cash on cash basis, right, there's two types of leverage you could look at. A cash on cash basis, right? So it's whether you have positive or negative leverage on your operating yield. But then there's the overall investment leverage, right? So you could actually have negative cash on cash leverage, but positive overall leverage. So in other words, if we had, say, a mid-6 cap rate and a low 6 coupon on our loan, right? That would be positive cash on cash leverage. Let's say we had a high 6 coupon on our loan. Well, now we have negative leverage, but your overall return on that investment is probably going to be, call it like 7-8% easy with appreciation of the property. And so there you obviously have positive overall return.
Yeah, this is great. And I think for our listeners, we've really made a conscious effort on the show here to try to dig deeper on some of these concepts beyond just the headlines. And so I know as we kicked off 2026, that was one of our themes, was to dig beneath the headlines. And this is another example of how we're trying to do that. So I appreciate you taking the time to kind of walk everyone through that, Stephen. And obviously, if somebody has any questions or wants to do a deeper dive even than what we just did on the show, feel free to reach out, podcast@trepp.com, and we can set up some time for you to sit down and talk with Stephen. And yeah, if you're doing those types of calculations and cash on cash in an intro to CRE class for non-CRE or non-real estate majors,
Poor folks.
Yeah, they're probably wishing they took the other section offered by someone like me that's probably not getting into that on an intro basis, but they're going to be better off for it. So yeah, thanks for doing the deep dive on this one, Stephen.
Now, in fairness, I didn't test him on it, Lonnie.
Listen, that's a nice caveat. Is in the lecture you should go a little bit deeper.
So let's turn our attention to some of the headlines and data across property types that we saw this week. The first story here we caught in BizNow, and that's that Harvest Properties and Lone Star have formed a JV to recapitalize 600 California Street.
Yeah, we've talked about 600 California a few times in the past, because remember, 600 California was, in a CMBS deal. So Harvest Properties and Lone Star Funds formed a JV to recapitalize 600 California Street, which is a 20-story, 360,000 square foot office tower in San Francisco's financial district. The deal is a distressed office reset. Lone Star acquired the property out of receivership after WeWork Capital Advisors stopped paying rent in April 2023. WeWork had bought the building for $332 million in 2019. The debt basis really tells the story here. A Lone Star affiliate bought the building's non-performing $240 million CMBS loan for $130 million in January, and the property later failed to attract bids at auction, effectively handing ownership to Lone Star. Harvest is stepping in as the operating and repositioning partner, taking an equity stake and overseeing leasing operations and improvements to stabilize the asset. The repositioning plan includes visible tenant-facing upgrades, a renovated plaza and lobby, a new rooftop deck, and 10 to 15,000 square feet of amenity space, including a fitness center, tenant lounge, and flexible meeting rooms. Now, the broader San Francisco office story is starting to look less one-sided. JLL reported more than 1.6 million square feet of net absorption in first quarter, helped by AI companies expanding by nearly 700,000 square feet, pushing vacancy down to 32.6%. Still a lot of road to plow. So distressed pricing is still very real, but better located assets may be finding a path back through recapitalizations, new sponsorship, and targeted investment.
This is a tale as old as time, Stephen. Isn't this where you make your money? I mean, if you wait until that vacancy number is much more palatable, or you wait until absorption gets to a number that makes it look, like the market's on fire, you've missed your window. I mean, this is where you got to be, and you have to have conviction. But like Lone Star, this is what they do. They're adept at doing this. They're going to have a good basis in this property. And as we've seen with San Francisco and the AI leasing boom, this is going to come back. This is going to play out in a way that I think is a positive story for them. You just have to be well capitalized. You have to be able to handle the carry cost, and you have to have some pretty strong conviction during the comeback, because the comeback doesn't happen overnight. But again, as we talked with our friend Mike from JLL on the recovery of offices and the guest podcast, you got to look at some of these markets and say, we're going to make a bet. And that's how you get the huge payoffs. And I think San Francisco is one of those where people will look back in 3, 5, 6 years and say, we missed a generational buying opportunity when these assets were effectively free. And so I think this is a story. We'll cover it again. They're going to start leasing this back up, and this will be a positive story before we get done talking about it.
Now, Lonnie, I saw another headline this week, and I believe it was actually you who tagged this one. It's right in your backyard. It's right on top of, basically what we were talking about last week. More pain in downtown Dallas.
Look, it pains me. I'm Texan through and through, and while I'm more Fort Worth than Dallas, I'm a huge proponent and supporter of the Dallas commercial real estate market. And it's a challenging storyline that continues to present itself here relative to the downtown office market. So we detailed some of the challenges that are being created by AT&T leaving downtown and moving out to the suburbs, and the benefit that it's creating in the suburban, location. And then literally, as soon as we got done recording last week, come to start researching for this week's show, I see Fifth Third Bank has now decided it's moving its regional headquarters out of downtown Dallas. They just completed their acquisition of Comerica, so they're leaving Comerica Bank Tower and shifting north to Preston Center. So their new headquarters is going to be at 8300 Douglas Avenue in North Dallas. So again, more North Dallas kind of migration. So Fifth Third signed a long-term lease for 2 floors, and they're going to open an on-site banking center there. And this is supposed to take place in late 2028. So this just adds more to that list of downtown Dallas corporate departures. This is the first, announced part of the Fifth Third, post-merger real estate optimization strategy. So they're saying that Dallas is going to be one of its 5 major employment hubs. So that's still good for the region, and they're going to maintain multiple offices across the area. But for that downtown Dallas office sector, it's just another blow to what's already a weak marketplace. And so, if you want to find a silver lining, and we always try to, Fifth Third is still making a major, growth push across Texas. So the headline, positive here is they're going to open 150 new branches across Texas by 2029 as part of a $700 million investment. They've already secured more than 50 sites, including 23 across North Texas. So, I think that's a silver lining positive here. And we didn't really, do a deep dive on this, Stephen, but I haven't done a boots on the ground, video segment in a while. But I think the timing is maybe right, because where I'm at out west of Fort Worth, there's been an inordinate amount of new bank branch construction. And it's really remarkable because, you have this like competing narrative where people are saying bank branches are dead. And you're seeing a lot of the legacy bank branches being converted to some sort of secondary use. But on the flip side, I mean, literally 10 or 15 newly constructed bank branches within probably a 10-mile radius of where I frequent. And, with them saying Fifth Third's going to open 150 across Texas between now and 29, it's a really interesting, dynamic there between 2 competing narratives.
I mean, I think I got half a dozen within a 10-mile radius around me. I mean, easily. So I think it's honestly a, migration story. It's where you're seeing strong positive migration trends. Those bank branches are going to follow. Where you've had kind of, some out migration or just a sideways trend, and foot traffic has fallen off massively because, well, e-banking takes care of most of our needs these days. Yeah, the bank branch just can't justify staying open in what probably is fairly expensive real estate to occupy.
And one more office story here. This comes from our friends over at CRE Direct. They reported that Braven Office Commons, a 749,000 square foot property in Bellevue, Washington, has been placed on the sales block by its receiver as its foreclosure process begins.
Yes, this property serves as collateral for $304 million of CMBS debt that's split into 2 pieces, with a $229 million slice in a 2020 BOC deal and the remaining $75 million in a 2020 BN26 bank deal, which is a conduit deal, the bank shelf. The financing pays a 3.2% coupon and is set to mature in January 2027. The debt was transferred to special servicing in September 2025, the month after its former sole tenant, Microsoft, moved out upon their lease expiration. So since Microsoft's exit, the property's owner, Invesco, has not made any loan payments. Prior to losing Microsoft, the property was on track to generate $33.5 million of net cash flow last year. So this has been a really common thing to see with some of the more recent large office deals that, well, would have penciled pre-COVID or early COVID that have large tenant exposures and tenant expirations. Oh, not looking so good on that lease roll.
Yeah, at this point, when you see Bellevue, Washington in a headline, you don't even really have to read the story. Like, it's going to be Microsoft. It's going to be something that's challenged. And, this is kind of a contradiction to what I said earlier about some of these office markets. This is one where you have significant overconcentration by a couple of very large tenants that really control the success or failure of that marketplace. This is probably not a market where I would be as optimistic as I am, say, in San Francisco. We'll see what happens here. It's not the first time we've talked about this. It probably won't be the last time until this kind of gets reset in the basis side of the equation and things can turn themselves around.
And another story here from the CRE Direct team. This one is in the multifamily segment. Dwight Capital has originated a $114 million HUD loan for office to residential conversion in Milwaukee.
Yeah, we don't get to talk Milwaukee or Wisconsin too often. And to see an office to resi conversion here, I like this. This is, not our typical storyline here, at least not for the market. So Dwight Capital originated a $114 million HUD loan for the redevelopment of the 34-story 100 East Wisconsin office tower in Milwaukee, and they're going to turn it into 373 apartment units. So according to Dwight Capital, this is the largest multifamily HUD loan ever originated in Wisconsin and the largest 221D4 loan in the lender's history. Additionally, the city of Milwaukee is providing up to $16.6 million through tax incremental financing, or a TIF. The conversion is being completed by a venture of Klein Development and MOS Real Estate, which bought the office out of foreclosure in 2023 for $28.75 million. The apartments will have studio to up to 3-bedroom units, as well as a roof deck with a swimming pool, fitness center, yoga studio, spa, and co-working spaces.
I wonder on this deal, Stephen, if they created a TIF just for this, because typically, a TIF is a broader geographic region, and those funds are made available for external kind of mowing, street beautification projects, and other things. I don't know that I've ever seen it actually used for like a conversion or renovation or something like that at a property level.
That surprised me as well. I was like, TIF, wait, that's usually like a geographic units. But okay.
Yeah, I mean, but I right those boundaries are created by the locally elected officials. So, I mean, they clearly have some ability to create those boundaries as they see fit. So, I mean, I could see some aspiring developer that maybe had the ear of some folks to say, hey, let's put this property singular in a TIF, and then you'll reap the benefits of turning something that's blighted into thriving residential property. If you're in that Milwaukee market and you have some insider info on what's happening there, feel free to email us podcast@trepp.com, because I'd love to learn a little bit more about this. You see historic tax credits, you see all kinds of other incentives to get development like this completed. It's the first time I've heard or seen of them using TIF funds, but would love to learn more about that. So if you have anything for us there, I'm sure we have some listeners in Milwaukee. I hope so. It'd be great to hear from some folks that maybe have a little bit closer perspective on this one.
And speaking of office to resi, there was an article in the Wall Street Journal this week about a developer who has targeted Denver for one of the most radical experiments yet in converting vacant commercial space into residential units.
Yes, this Wall Street Journal article It's a fun one. So if you haven't read it, I highly encourage you to go out there, check it out, because there's more meat to this story than probably what we have the time to get into in the podcast. But get this, Lonnie, the opening sentence here for the article. A 38-year-old, slight of build, with an urban hipster's wispy beard, thinks he can revive the emptiest downtown in the country. That opening sentence says a lot about what you're about to embark on for the story, does it not?
Well, listen, and I think this is, I mean, listen, there was so much stuff on Twitter and X this week around just syndicators and other things. It's like when they're describing you in that frame and not based on actual work experience, a 30-year veteran of commercial real estate redevelopment projects that have, executed X number of office to residential conversions. I got to say, I don't have a ton of confidence. Like when the intro is talking about your build and your vibe, it does make me a little bit nervous, especially in a market like Denver, where there's really nothing positive happening there outside of maybe a few very select submarkets.
Yeah, I got to hand it to Peter here, Peter Grant at the Wall Street Journal. He did an excellent job of researching this one. Now, what this fellow has done, he's picked up the 785,000 square foot complex in downtown. This was the Energy Center. And this is a testament to conviction, I gotta say. I mean, the guy bought a ton of space in downtown Denver, and the clearing price was shocking. He paid just a little bit more than $5 million, 97% below what a previous owner paid for it in 2013. I mean, talk about a reset.
Listen, I don't want to be like, some negative, person that comes on here and says it's still too much. But I got to say, it's still too much. I think the all-in cost on this, based on what they're proposing, is like $450 a square foot. And the math isn't going to math. I don't know how this works financially at those numbers, given where it's at in the market and what the demand and the pricing is going to be on a completed project basis. I mean, this is just where I think in some of these instances, and we saw it in St. Louis, where you saw buildings trade, the previous trade, 200 million, current trade, 10 million, retrade at 2 million, and still face challenges. This is one of those scenarios, in my opinion. And again, I'm not a Denver native. I don't have my hand on the pulse of the Denver office market at a level that I'm probably proclaiming to on the show, but it definitely still feels rich to me, given what I do know about that market and what I do know about the complexities of these conversion projects. I think it's a great story, and I agree with you. Peter did a good job of just articulating the plan here. And the thesis seems great. But again, if I'm using the word thesis with a real estate investment, I don't know that I'm hitting the mark here.
Yeah, I mean, he's planning to churn out 1,100 apartments. He's also planning to put in a bookstore, art gallery, children's museum, daycare center. I mean, I got to say, a lot of those amenities are going to be necessary to draw people back to Denver's downtown, because the perception of downtown Denver is not great for a lot of local residents. And what's really crazy about this is how much stock this gentleman has taken up. He's taken control of more than 7% of Denver's traditional downtown office space. I mean, that's absolutely wild.
Well, I mean, I think, listen, to give the guy credit, like I said a moment ago, you have to have conviction and you have to be willing to go in when nobody else is. And he's certainly doing that. My question is just, is the money better spent on making this big conversion play, or is it potentially just modernizing and creating a better office environment for some of these assets that are just probably in need of some capital expenditure? And I think that's the part where, not being so close to that market, I can't make that judgment. And obviously he feels he has, and the conversion route is the route he's going. But I think that increases the risk at a disproportionate level, especially when you're talking about adding some of those other amenities. Those usually require some sort of other synergies to draw the foot traffic. I mean, most markets, you have a cultural district where you have your museums and your playhouse, where people host plays and other things where you generate a critical mass of people to come for those reasons. Creating a one-off, museum or children's, place, whatever. I don't know that that's going to have a lasting impact. And those tenants typically don't pay high market rents for those spaces. So I think 7% of Denver's office market, that's something that is very compelling to me. Like that's a significant share of that market where you could definitely impact it. And I don't know that, like you said, the perception of Denver's downtown, I don't know that it's a perception. I think the reality of Denver's downtown is just not good right now. I mean, it's one of those cities where the homelessness is taken over, and it's just not it doesn't feel like a safe place to be. And it's honestly disheartening. They have incredible amenities. I mean, you can basically walk to a Colorado Rockies game in their stadium right in downtown. They have the football and the basketball arena and stadium right across the highway. Denver is an incredible place. I love it there, but they've really seen the city just take a very bad turn for the worse.
Yeah. And when you combine that with some of the costs you're going to run into, Denver is not a light-handed municipality when it comes to, zoning and building codes. So, I mean, just in the asbestos and single pane windows alone, he's going to have to spend $30 million. So I fear this is going to face some pretty severe cost overruns, red tape delays that are going to, potentially cause a cost spiral. So I really hope that there's very active public-private partnership discussions here, and that this thing is able to overcome some of the challenges that have taken down some of these projects in the past.
So a lot to cover this week, and I know we already have segments planned for next week's episode, and we'll be sharing a few new guest episodes over the course of the next few months. So always more content coming from the Trepp team. I have a few programming notes here before we close. I mentioned this on last week's episode, but as a reminder, we have some big conferences coming up. Our team will be at the Global ABS Conference from June 9th through 11th in Barcelona. So if you're in the structured finance business, CLOs, CMBS, and would like to meet with our team there, if you'll be in Barcelona, reach out to us. We'd love to set up time with you. If you're not going to be at the conference and are curious about what we're building across our Trepp CLO products or our CMBS solutions, we'd love to set up time to meet with you as well. We'll be at booth F10 at the conference, or are happy to get on the phone with you anytime. That same week, our teams in New York will be at the CREFC June 2026 conference from June 8th through 10th. And here we'll be talking about all things commercial real estate finance, CMBS. We'll be digging into a lot of our new enhancements across our products and solutions. And we'll also be sharing our takes on the market. There's a lot of great speakers and panelists at this conference, and we love to compare notes and talk about what we're seeing in the market with these speakers and others in the industry. We'll be at booth 12, or we'd love to book a time with you to meet with us on the 7th floor. So reach out to us at podcast@trepp.com if you'll be in New York, either at the conference or if you just want to meet up around that time. Turning to shout outs. John H. said it was great meeting our team at our Trepp Connect conference a few weeks ago. He wanted to thank us for hosting and is already looking forward to next year's event. Tom L. from American Landmark mentioned he has been a longstanding and, according to him, probably in the top 1% of loyal listeners. So thank you so much, Tom, for your support and tuning in every week. William O. wants to know when our team will be in the San Francisco area. He wants to host us for a market update session for his team. I know we've been doing a lot of these lately. I think you've been on the road, Lonnie. Steven's been at conferences, and several of our subject matter experts have been meeting with different groups across the industry to give market updates or share some of what we're seeing across our data. Sarah T. was interested in joining our next Market Pulse webinar. If you don't join our webinars, reach out to us at podcast@trepp.com and we'll make sure you're on our list. Terry R. is looking forward to meeting the Trepp team at the CREFC conference. James N. was also interested in our webinars. Ricky T. thanked us for a great couple of days in New York. He said he loved our casino event. We got a lot of great feedback on that. That was a great chance for everyone to network and really meet with all of the attendees that joined us. Andrew B. thoroughly enjoyed Trepp Connect as well and loved all of the discussion around data centers and that we brought some clarity to that market. Jack P. was interested in our CMBS report that we released on reappraisals. So we will send you that. And if anyone else is interested in the reappraisal market, reach out to us. Marty L. wanted to see what we had to offer for CRE CLOs and any of our latest metrics and figures on that market. He said he loves our show and our products. And Sean P. said, we deal in multifamily in New York City and would be keen to see what you have to offer for your AI solutions.
So Haley, you mentioned I'd been out doing some market updates, and so I talked about a few of them, but I didn't actually do my my shout outs that I should have. So I want to give a few of these for the last couple of weeks. So Grant M, Cole P, Jordan D, Henry J, and Kimberly H. Had a great time talking with your group and appreciate you reaching out and having me join your presentation. Sing K, same. It was really great. I got to see him at 2 different events and appreciate his friendliness and his invitation to come and speak to his group as well last week on Friday, which was a great experience. And actually had a couple of different folks at the Appraisal Institute local chapters reach out over the last couple of weeks. So I'm working through getting those things on the calendar. But Jeffrey S. up in Ohio has asked that I come up in December and give an update for them. And then I had an outreach here from Jan W. Here in the Dallas market for the North Texas Appraisal Institute annual conference. So I've gotten that one already on the calendar for September 18th. So, we appreciate your continued support of what we do. And Stephen and I enjoy coming out and meeting with people in person and giving our perspective on the market. So shout out to those that have been connecting with us recently, and look forward to continuing our mission of bringing real-time data insights and expertise to the marketplace through our products platform and in-person meetings.
And a final shout out here to our Trepp teams who are running the JPMorgan Chase Corporate Challenge tonight. This is a really cool event. It brings together our teams, it brings together corporate communities and colleagues across the industry. And it's always really fun because we're all wearing Trepp shirts in Central Park. And every year we meet podcast listeners. We have clients yell out to us saying hello to Trepp. So hopefully we'll meet some of you all tonight. And if you were there, because you'll be listening to this after, send us a note and maybe we can find some time to meet up in New York City. So with that, we'll close. Thanks to our producer, Mariana Sabrana. Join us next week as we look at what's happened during the week and how it may be impacting you. If you have a question or just a comment, send an email to podcast@trepp.com and subscribe to the TreppWire Podcast with your favorite provider. Thank you for listening and stay well.
All right.